Good morning from London. This is Bloomberg Markets Today. I'm Anna Edwards alongside Guy Johnson. With the cash trade just less than an hour away, here's what you need to know. UK investors turn their attention to economic data for rate decision clues after BOE Governor Bailey leaves the door open for a June cut. We will break the latest GDP data shortly. European futures trade higher after a positive US session with jobs data stateside supporting the case for Fed rate cuts this year. Plus, a Bloomberg scoop. President Biden is set to unveil sweeping tariffs targeting Chinese EVs and strategic sectors, with an announcement possibly coming as early as next week.
Let's take a look at the markets. Believe you me, GDP is about to change some perspectives out of the UK as to what is about to happen next. Let me show you what the numbers look like. Futures fairly positive at the moment. Keep an eye on some key lines for the US 10-year. 443 is where the Fibonacci level comes in. Pay attention to that. Euro dollar, as you can see, under a little bit of pressure. Markets today starts right now. Friday the 10th of May. I hope you didn't hear my reaction to the UK GDP data as it broke when Anna was speaking, because it's something of a humdinger, and I wonder whether it's going to change some of the narratives around what we heard yesterday from Governor Andrew Bailey. The quarter-on-quarter number comes through at 0.6. Now, remember, the last number was negative 0.3. This is when we were in recession. And basically, we've completely unwound that mild recession that we were in. The year-on-year number comes through at 0.2. The month-on-month number comes through at 0.4. This is an economy that feels like it's re-accelerating, Anna. Is this an economy that feels like it's in need of rate cuts? Right,
and this taps into what we were talking about on the UK and Europe yesterday, and on the ECB, talking about how you fit the narrative together for an audience that doesn't tune into this, you know, the wider audience very often, how you fit together a recovery story economically and a rate cut story. Anyway, a bit more on the detail, though. This does confirm that the UK out of recession. Of course, we were in recession Q3, Q4 of last year, so this is a positive print, a more than positive print, as you point out, much better than expected. The estimate for March, because the only new information here is for the month of March. We knew January and February, unless we've got revisions, which I haven't quite looked yet.
I can't see any yet.
Yeah, so March is the new information, and instead of getting 0.1, we got 0.4. So it is much stronger in March than we'd anticipated. And how does that sit alongside all of the dovish signalling we got from the Bank of England yesterday?
The prime month has been revised higher as well now.
OK.
Revision for that as well.
OK.
This is the problem. So there is now this conversation which is beginning to emerge, which is the Bank of England cuts quite aggressively, then has to reverse course quite quickly. And I do wonder whether that is going to be something that people start actively thinking about. This doesn't feel like an economy that is exactly roaring, but it doesn't feel like it's an economy that is in desperate need of rate cuts from a growth point of view. Now, I wonder whether the Bank of England is focusing, therefore, more on what is happening with the inflation narrative, which does continue to come lower.
Yes.
But does that persist, given the kind of growth trajectory that we are currently seeing with these data? And
I find myself coming back to the real wages story in the UK, because it lagged for so long, and that's what made, you know, the so-called cost of living crisis so bad for so many people. But even the Bank of England now predicting a rise in living standards this year, saying that wages will be up by 5.25% this year. That is much higher than inflation. How does that change the economic trajectory? How does that boost inflation, if it does? And that's one of the concerns, is where inflation goes at the end of this year. That's certainly something to watch.
At least the Bank of England in some ways is operating with decent inflation data. It's not operating with decent wage data, which I think is problematic right now in terms of how maybe they're trying to set policy. There was also some interesting elements within the report that was published yesterday about the fact that some of the agents are reporting actually the economic data that they're seeing, or the reports they're getting, suggest that actually economic growth is not as strong and consumers are more stressed than maybe the headline data does suggest. So, again, a really confusing picture. But the headline numbers speak to an economy that is re-accelerating. How much of this will, therefore, these data, how much will they unwind some of the move that we saw yesterday, which we started off as being kind of maybe June? Then we got a kind of coin toss for June. And as Lizzie was saying just a moment ago, by the end of the day, it was like June is the racing certainty in terms of what we're going to see for a cut. OK, yes, and we'll have plenty of moments to rerun this conversation over the month ahead, because we're going to get, before the June decision, we're going to get the inflation prints, we're going to get wage data. So we've had the GDP contribution, if you like, for the first quarter. But what will the other dynamics tell us? So that's certainly something we'll continue to watch. So that's the UK macro story.
interesting as it is, should we go to airlines, aviation?
Of course, my favourite subject. Luis Gallego out with his numbers this morning. Q1 revenue 6.43. That's ahead of estimates. Strong demand for travel has helped deliver a very good first quarter. This according to IAG. This is an airline with British Airways, with Aer Lingus. This is much more skewed to the North Atlantic. Therefore, it is beginning to see a pickup in demand in those areas, and that is positive. But it's interesting that we've also seen Michael O'Leary over the last few days talking about maybe softer fares over the summer, and that spooked a lot of people within this sector. So to a certain extent, you do wonder whether IAG is going to be insulated from that by the North Atlantic. Strong demand for travel helped to deliver a very good first quarter.
Yeah, and on the UK side, maybe the real wages story plays in. But it's interesting, in the run-up to these numbers coming out, I was looking at all the previews. I don't think there was one I read that didn't have transatlantic and business travel in there somewhere. So these being such drivers of profitability for an airline like British Airways and to some degree some of the others, and they do have that North Atlantic exposure that you were talking about. It's been really fascinating to watch business travel recover to some degree, but of course not back to where it was. But post-pandemic, we saw the front of the cabin often being filled by the non-business traveller, just sort of the wealthy leisure traveller who'd saved up so much money during the pandemic. Now, that stock of savings has been coming down. So that doesn't last forever.
Try and get a train ticket to Paris this weekend.
You've tried.
I have tried. Taylor Swift is playing in Paris this weekend.
Oh, dear.
It is
That's not why you're going, though.
It's not. Well, I may be going. We may not be going. But
okay.
let me just tell you that trying to get a train ticket to Paris this weekend is something that is problematic. I blame Taylor Swift for this. The other thing that is worth pointing out is, and I'm going to come back to my favourite subject, which is multiples. These stocks do not trade on very high multiples. So Ryanair trades on about has got a PE of about 10. Most of the legacy carriers trade on around 5. That is historically really low, and some of them are even lower than that. You've got all kinds of I think one of the analysts puts it this morning that the valuations are not demanding. So you do wonder whether there's a sort of gearing story here, how if there is a recovery, if we can get the cost story under control, how geared these share prices are to potentially any kind of an upswing. Now, does that happen, and can it happen at the same time as you're seeing costs coming back under control? Because these are the sort of the two major problems at the moment that these guys face. You've got a reasonably strong demand picture, but it's not quite strong enough to overcome the incredible cost picture that they're facing and the increased debt that was taken on during the pandemic. Yeah,
the cost story is certainly very relevant. If we widen the conversation and think about where we are more broadly in terms of the macro backdrop, Guy, but sticking with stocks, I mean, yesterday we saw up near an all-time high at the close in the United States, AI boosting the Apple excitement, it seemed, but also the US data on jobs, as we referenced in the headlines. You know, that bad news is good news dynamic, as you pointed out earlier, back in focus. Claims coming in pretty high. Volumes were low, so maybe there's a lack of conviction. But it was an interesting Goldman Sachs pointing to the role of CTAs, so you know, the computers, saying that they were primed to buy in any scenario. And there's a lot more detail behind that statement, but they were primed to buy in any scenario, according to Goldman Sachs this week.
Yeah, it's been an incredibly strong week for stocks. It's been an incredibly strong week for risk assets, but you have had bonds and equities moving in both in the same direction, which always confuses me. I can never quite really understand how this happens. But to your point about the good news, bad news scenario, maybe that's there. The recession talk has re-emerged. It's interesting how stocks initially take that as a positive, but then ultimately have to factor that in as a negative. But it does seem we're on the upslope about that at the moment. But the biggest, the Milken conference, I think, has been fascinating, and the commentary that has come out of it has been really interesting. There's this kind of overriding sense of there's business to be done, deals to be done. But at the same time, there's this kind of split between those that are really positive about what's happening, or in the glass half full camp, and those that are looking around the world thinking, look at what's happening in Gaza, look at what's happening in the Middle East, look at the risks that we're facing, look at the kind of the election story that is coming up. All of those risks being sort of factored in by the other half. And the market feels really divided at the moment.
Yes, well, and that takes us nicely onto some of the geopolitical risks. Yep. Because if you're a global business, you feel that more intensely, don't you? And we've got a number of lines around China this morning that I think are worth bringing together. We referenced in the headlines President Biden next week, as early as next week, might come forward with this, this decision on Chinese tariffs. It could hit solar cells, batteries, EVs. We've seen some market reaction to this already. The yuan a little weaker, the CSI a little weaker. And this coming at a time when we're seeing pushback a little bit from certain areas of global business with Chinese exposure. Certainly the UK banking sector has been pushing back a little bit against what the UK government has been doing on talking tough with China.
Yeah, I think there's some large UK institutions that are quite exposed to China and therefore would probably like maybe the language to be toned down a little bit. But there's also some interesting surveys out suggesting that actually businesses are now seeing China as a less positive investment destination for their money as well. So they're less likely to put money to work in China because they see that growing geopolitical risk as a significant headwind. It's interesting, there's a company, Zika, which is this high-end...
You pointed this out to me.
High-end Chinese also maker. It's in a list in the States today.
I know, I was surprised by just that.
Yeah, precisely. No, that seems totally counterintuitive if you think about what is happening here. But they think it's going to give them the sort of the halo effect of being listed there. That gives them a positive story. The underperforming sector this week in Europe has been the auto sector. Every single other sector, I think, has largely done well this week. Stocks rising. But it's been the autos that have underperformed. This is a brutal, cutthroat, difficult market at the moment, even before you fold in the geopolitics.
And Zika might underdeliver versus recent expectations in terms of its listing as a result. It's interesting how businesses globally then navigate all of this geopolitical challenge and the extent to which they are prepared to push back against what Western governments are doing. With that in mind, I wanted to play just a little clip of what we heard from the CEO of Snap talking at the Bloomberg Tech Summit.
What I think is really important is that we come up with a durable framework to deal with these sorts of national security issues. I think the United States has recognized that there are these issues, but has sort of been dealing with them in sort of an ad hoc, one-off kind of way. And I think that has real implications for the economy looking forward. If you think about how many businesses in the United States, have a relationship with China, whether or not they manufacture there or they sell their products there, I think it's going to be really important for those businesses here in the United States to get a lot of clarity.
So there's one view about what's needed on the.
Good luck with that.
You're right. Well, what's needed on the doing business in China front. But interesting, you mentioned this survey. The EU Chamber of Commerce doing a survey. This is the EU Chamber of Commerce in China, and saying only 13% of these European businesses they survey see China as a top destination for investment. That's the lowest since 2010, which just underscores where we've come to.
Big Chinese companies big German companies have spent a lot of money in the chemicals, particularly in the chemical sector, investing in China recently. I wonder whether or not they're rethinking some of that investment that has been made. But if everyone wants clarity, does he honestly think going into an election that he's going to be getting clarity? We got Donald Trump sort of obviously talking about significant tariffs, blanket tariffs, and maybe that's the way you get clarity.
But as a business leader, you have to. That's what you seek, isn't it? You have to ask for it.
But you have to adapt to the reality that you see in front of you. Yes, it would be nice to have some clarity, but this is an evolving situation that I think businesses, in some ways, is a passenger.
Yeah, and clarity doesn't necessarily mean that it moves in your direction in any way.
Also very true.
Let's have a look at the daybook, shall we? Let's have a look at what is coming up for you today. 11 a.m. UK time, Standard Chartered has its AGM. We've had a few high-profile AGMs this week. 12:30 London time, the ECB publishes its accounts for its April meeting. We get at 3 o'clock University of Michigan consumer sentiment for May. We're on sovereign rating watch with Israel, Poland, Republic of Congo and Luxembourg. Finally, central bank speakers are plenty for you. ECB, Bank of England, Fed. Lots of Fed voices, I think, and a couple from the Bank of England later on today.
Yeah, maybe we'll get some clarity on exactly what is happening with the vote split. Maybe we'll get some clarity on exactly what is happening with the economy, because in some ways what we've had over the last 24 hours is confusing. Yeah. I'm genuinely... you've got a GDP number that is blowing expectations out of the water. Take a look at the Atlanta Fed now GDP forecast, nowcast data out of the States at the moment. It's talking about a 4% GDP growth story in the States.
Yes.
This is not an economy, despite the recession talk over the last 24, 48 hours, where it really started with the jobs data this time last week. But that data speaks against the idea that this is an economy that is falling into recession anytime soon. And the UK data today paints a similar picture. Yes,
I mean, you're talking about European central banks with only one mandate, and that's around inflation. So interesting to ask our guests then how this GDP story weighs in as an improving GDP picture in the UK and to some degree in Europe. Over in the States, more complicated, obviously, with dual mandate. But the cracks in the labour market are mentioned by many, but they're not, it's not a labour market that's entirely falling over right now.
Doesn't feel like it's falling over. We'll obviously get more data. the next week, the data out next week are going to be fascinating. The CPI number next week is going to be, I think, momentous in terms of maybe setting market tone. Anyway, coming up, US set to impose tariffs on China. We've just been discussing it. We'll get more on that story. Plus, IAG says strong demand drove a very good first quarter. We'll dive into British Airways' parent company's earnings and look at what else you should be watching in terms of the stock story. It's just Anna and me today. Honestly, we've got lots of things we want to be talking about, but we'd love you to join in our conversation as well. As the sun comes up in London, join the conversation. IBE Plus, BBTV Go is the function. This is Bloomberg.
In the history of the MPC that most of the cutting cycles in inverted commas, have actually been prompted by some sort of shock or other, rather than being what I might call a natural cyclical sort of, we've reached the top and now we go down the restrictiveness curve. So we don't have a lot of, I mean, I would just caution, there isn't a lot of sort of history really to.
Bank of England Governor Andrew Bailey speaking there with Bloomberg's Francine Lacroix, of course, talking about the prompts in recent times for rate cuts at the Bank of England. And as he says, as we talked about yesterday, a lot of those coming during times of crisis. Let's get another view on this. BNP Paribas Markets 360 has switched their call on the timing of the first Bank of England rate cut from August to June. Joining us now is their head of global macro strategy, Sam Linton-Brown. Sam, good morning. So that, as a result of what we heard from Bailey yesterday, was it that June is sort of not on or off the table, but seems to be very live in the market's view?
Morning, Anna.
Morning.
Yeah, absolutely. So what we'd point out yesterday is two dovish surprises relative to what we, and I believe many in the market, had expected. The first was we got another vote in favour of a cut. So that balance on the committee is beginning to shift. And the second, and just as important change, is an adjustment in the formal written guidance, which we weren't expecting. We didn't think that easing bias would be strengthened. So our interpretation is this is a Bank of England which is increasing its confidence in disinflation, which in turn gives it confidence that it can begin cutting if, as we expect it to over the next couple of months, it gets more information that implies that disinflation trend is very much in
So
place.
we got lots of these dovish clues yesterday, and you've set out some of them, Sam, and that's fine. And that was to some extent expected, maybe more than expected, but that's kind of easy to get your head around. Then that's met this morning by some GDP data that comes in better than expected, better for March, upgrades to prior months as well, 0.6% out of recession. How is this going to come together, do you think? A recovering GDP story at the same time as rate cuts are going to be introduced?
It's a bit like the Eurozone. Growth in Q1 surprised on the upside, and the momentum into Q2 seems even stronger than Q1, yet both of the central banks are signalling that rate cuts are coming. In some respect, that seems at odds. I think the key point to make is this isn't policy loosening, it's policy normalisation. For example, in the UK, policy rates being above 5%, we think it's going to take perhaps 2 years from today for policy to get back towards where we would see neutral. So policy will remain restrictive even as the Bank of England cuts rates.
Where's neutral?
We think a shade below 3%.
Right.
And even if that assumption is a little bit too conservative and neutral is 3.5, for example, we only see the Bank of England getting to that level by the end of 2025.
So policy remains restrictive for a while. Is that going to therefore reduce the risk that we see the economy accelerating too fast to the point at which inflation becomes a problem again?
The Bank of England have become increasingly forward-looking in the way that they're setting policy, and they're really attempting, I think, in their revised communication approach to downplay spot data, focus on forward-looking. Yep. So they'll be very concerned about a scenario in which they ease policy now as growth is recovering, and in turn, that pushes growth up too strongly in the future.
How big a risk is that?
We'd say it's a relatively low risk because the strengthening in growth we're seeing today is largely due to one-off positive impetus from the energy shock abating.
OK, yes, there's a lot about the energy shock in the pricing to come. Do you think the Bank of England distanced itself effectively in the way that the ECB has been trying to do from what we're seeing in US bond markets? Because that seemed to be one of the conundrums in recent months, that some parts of the European bond market space were moving more with the US and the Fed narrative than maybe the domestic data and the domestic conversation.
the cross-market beta between bond markets will remain strong, but I think in terms of trying to communicate that the policy reaction function is different, both the ECB and the Bank of England have done that, in my opinion, quite successfully.
Yes.
And I think there's good reason to. They have a lot more confidence than the Fed that policy is sufficiently restrictive to get inflation down.
If that cross-market beta, though, as you describe, if it stays strong, does that limit the transmission effect of the cuts that we're going to get?
I think it would if we were very far away from expecting rate cuts. But in reality, the ECB is saying it's going to cut in a couple of months. Bank of England's potentially signalling it's going to cut in a couple of months. So if we get to June and they cut, then that's really going to show the market that they are happy to have that transatlantic divergence.
If gas prices continue to climb, are we going to have a problem?
Glad you brought that up. So our commodity analyst has a view that the market's underpricing the risk of this year's winter 24, where the capacity to have LNG in Europe is still quite low, which won't be the case in the future, but for this winter still is. And so there is a risk if we were to see a significant geopolitical escalation against our central case, but of course it's always a risk. That would have quite a strong feed-through, in our view, to winter gas prices for the upcoming winter contracts. And that isn't well priced by the market. If we were to see that, it would absolutely present a conundrum for European central banks due to the inflation expectations.
How much more of a problem would that be if we had a very weak sterling?
I think the likelihood of the pound weakening sufficiently that it has an impact on the Bank of England's reaction function is quite low. A 10% move in the trade-weighted exchange rate typically corresponds to about 0.4 to 0.5 on inflation over the next year, where gas prices, as we saw a couple of years ago, moving several hundreds of percent has a much greater impact.
Sam, can I ask you about the dollar? Thinking about FX, we had a guest on yesterday who was looking at the long positioning on the dollar and using that as not the only reason, but one reason why they were a little more nervous on the dollar. But you are quite bullish on the dollar. Explain your thinking.
Into the inflation data next week, I'd actually have a lot of sympathy with the view that the dollar could be a little bit more reactive to a weaker number than a stronger number, because we would agree on our proprietary positioning metrics we run at BNP Paribas, the market's long dollars. But on a 3-month to 6-month view, the cyclical backdrop in the US, Guy was just mentioning the nowcasting GDP data in the US, a Fed that's diverging from both the ECB and from the Bank of England and from other central banks in Europe, like the Riksbank, like the SNB. It means both the relative rates and relative growth backdrop, in our view, is going to be quite dollar supportive. That isn't consistent with a big appreciation. The dollar's already so rich, the market's already so positioned, but we think it can grind a couple of percent stronger versus most core G10 currencies.
The labour market data in the States is starting to prompt the idea that the US is heading back towards this idea that we're going to see some sort of a mild recession. How justified is that view?
I don't think it's justified yet.
Yes.
We've had 1 week of initial claims, 20K above expectations. That's a data that
Payroll
previously...
was a little weak.
A little weak, but relative to very high expectations. So the run rate of the labour market, I think, from the Fed's perspective, is still strong and potentially still consistent with a neutral level of job gains. So if we were to see the hard data catch down to some of the survey data that has been very weak in the US, then one would need to turn bearish on the dollar, but insufficient evidence that that's likely over the next few months.
We'll see what the consumer feels a little bit later on. UMich data dropping onto our terminals. I think around 3 o'clock. Sam Linton-Brown, Head of Global Macro Strategy, BNP Paribas Markets 360. Thank you very much indeed. OK, coming up, money managers are being lured into EU bonds in anticipation of a major change in their status. We're talking about EU bonds here, not govies. We're talking about the supranational stuff. We'll talk about that story next. This is Bloomberg. .30 in the morning here in London, 30 minutes away from the start of equity trading here in Europe. It has been an epic week, you could argue, for European equities. We'll see how the Friday session develops. We've got a bunch of things we need to get through before we get to the end of the day. I want to flag what's happening with the cable rate, what is happening with sterling right now. This is in some ways counterintuitive. Certainly felt like it a little bit yesterday. Sterling rallied yesterday, despite the fact that we had ostensibly what appeared to be a dovish Bank of England. Yet sterling picked up the pace. I think that may have had more to do with the data out of the States than necessarily what happened here in the UK. But nevertheless, sterling rallied. And that has continued this morning, Anna. You see another tick higher for the sterling rate. This feels more logical on the back of this stronger than anticipated GDP number.
Yeah, certainly that number coming in at 0.6%, much higher than the expected, well, higher than the 0.4%, and confirming that the UK out of recession, that recession that was Q3, Q4 of last year. I guess this, to your point about this being, yesterday's moves being more about the US data, takes us back to what we were saying with Sam Linton-Brown, that there's such heavy transatlantic effect in these bond markets right now. And in terms of where we are positioned ahead of the start of European trade today, European futures pointing higher this morning, up by a few tenths of a percent, as you can see. The CAC 40 a little stronger, picking up from some strength on Wall Street yesterday. We saw the S&P up around 0.5%, closing very near to all-time highs. Some excitement around Apple and the AI story, helping to lift some of the tech names in particular. In terms of bond markets, then we will wait for the gilt markets to open. That'll be interesting when that happens, of course, in 29 minutes' time. But in the run-up to that, we've got the European bond markets, and I'm looking at the 10-year tenors right now. I can see those yields coming down just a fraction this morning. Not huge moves, but waiting to... I wonder if there is any read across from the strength of this UK data, because it pushes it... It's sort of in line with the narrative that we've been thinking about the European picture more broadly anyway, isn't it? That the European data maybe has bottomed out and that this is a recovery story.
Do you buy UK domestic stocks on the back of the data you've seen this morning? That would seem like a fairly logical trade, wouldn't it? And that has been a narrative that has been developing. You look at what's been happening with the catch-up trade on the FTSE 100. And that has been one of the factors that has powered European equity markets so strongly this week. The Stoxx 600 is up by 2.2% this week. Now, that doesn't sound like much, but that's a really decent rally. We're back north of 500 on that market, 516. It's been a market that has kind of almost sequentially, day by day, just risen and risen and risen. On the back of what has been some mixed data around the United States. And here we are this Friday, Monday, Tuesday, Wednesday, Thursday, we're up by 2.2%. Do we end the day higher again today? Fresh records. Yes, and the European story driven largely by a lot of those earnings stories that we've been covering. Shall I bring you some... This is a nice piece of research. This is actually in connection with US stocks. 22V doing this research, an investor survey of where they think the S&P is going to go next. Is it going to go up by 10% or down by 10%? What's most likely? And you'll like the results here. 52% say it's going to go up. 48% say it's going to go down. This is by 10%. You know, I mean, perfectly balanced market. Why do these surveys always end up with 52, 48? So it's interesting, but we were talking about what was happening out in California and what was happening at the milking conference. That felt like broadly, I think there was this kind of very kind of positive trend. Deals are going to get done. But it did feel like, just listening to the commentary, that actually there was quite a lot of division. Those that are worried about geopolitics, those that are worried about the impact of that, and those that are just looking at a US economy that's just, thank you very much, going higher and higher. OK, let's stick with some of these things, but pivot to something more structural around these markets. Money managers are piling into EU bonds in anticipation of a major shift in their status that would open up the bloc's debt to a bigger pool of investors. And as Guy said, this isn't individual sovereigns. We're talking here about the supranational. Is that the right word? We'll ask Greg Ritchie. Bloomberg's Greg Ritchie joins us now. He's been covering this story and can take us into the detail here. Greg, good morning. So why does the EU then want its debt to be classified as a sovereign so badly? Why does that matter?
Thank you very much. I think ever since the EU really ramped up its issuance programme in 2020 in response to the pandemic, it's been a little bit frustrated that its cost of funding isn't lower. It's an AAA-rated entity, but its yields are comparable to a lot of AA-rated sovereigns. And the key reason it thinks that its yields are higher is because it's counted as a supranational issuer rather than a sovereign issuer. And obviously sovereign benchmarks, a lot of investors follow those, they follow those indexes. It really wants to be added to these sovereign indexes. That will create forced buying by passive funds. Active managers can go overweight the benchmark. That will create the sort of buying flows that the EU thinks is needed in order to reduce its yields.
How much of this has already been front-run? I feel like I've been talking about this story for a little while. Managers have been anticipating that we are going to see some reclassification. So how much of the spread tightening has already taken place?
It's a great question. I think ever since ICE Indexes released its consultation last month, we've seen about a 10 basis point rally in quite a few EU bonds relative to peers. That's quite a large rally. And you're right in that when it comes to index rebalancing events and index inclusion events, investors try to front-run that. It's a case of buying the rumour, selling in fact. I think from now what we'll need to see is confirmation from a few other index providers that they're going to add EU bonds to their indexes. And secondly, it's about the supply picture. How many EU bonds are going to be issued over the next few years? Because it could be into the hundreds of billions. That could be a headwind.
So are they, I mean, coming back to the question at the core, I suppose, are they sovereign? Or should they be classed as sovereign? Or should they be classed as supranational? Because if they attract a higher yield because they're supranational, does that reflect the risk that maybe different parts of that supranational, I really can't say that word, national, might pull in different directions? You know, you've got different governments under that. Is that the risk that we're talking about?
I think you've really got to the heart of the tension. At a very fundamental level, the European Union isn't a sovereign entity. It doesn't have tax-raising powers. It's a supranational bloc of different countries with their own sovereigns. So, on one hand, on a philosophical, conceptual level, it isn't a sovereign. But then if you look at it purely from a bond market perspective, it's issuing hundreds of billions of euros, soon to be 1 trillion euros outstanding of debt. That makes it comparable to some of the largest European sovereigns. So when you think about that and the liquidity improvements we've seen, it looks more like a government bond issuer. So it's kind of getting around the dissonance between, on one hand, philosophically, it doesn't look like one, but from a bond market perspective, they want it to be seen as one.
Great stuff. It's going to be a story that we're going to pay a lot of attention
European
to.
philosophy early on a Friday morning.
Yeah.
Excellent.
Maybe ultimately one day we'll have a sort of treasury-like market here in Europe that doesn't feel quite so fragmented. Greg Ritchie on that story. We're going to keep an eye on that. Let's turn our attention, well, let's keep our attention, you could argue, on what is happening with the bond market story. Pooja Kumra, Senior European and UK Rate Strategist at TD Securities, joins us now on set. Good morning.
Good morning.
I can't wait to talk about that story, but the story that is really getting
we love EU.
Sorry?
We love the EU story also.
Do you would you buy that? So would you be? Do you think spreads continue to tighten?
I think, as we said, it's like the buy the rumor. So going into the event, and I think what we saw is when ICE suggested that they will add EU to the index, the other index providers will also follow this story. So I think it's basically just pre-event kind of support that EU is getting. But I think the key would be for it to be, if we want to classify EU as a sovereign, I think what is key is the liquidity that the bond provides. So I think building the futures market and the repo market will also be key support for EU to reach that level.
Okay, you completely hijacked my conversation. Is it a zero-sum game? Do you not buy bunts and buy the supranational? Is that the trade, or do you think there is sufficient demand for both?
So I would say, bond market is much larger than what we have for EU market, and people go to bond just because of the liquidity. We have a futures market, we can go in and out of positions very quickly, but EU is not there yet. EU is actually 1/3 of what the French market and the bond market is. So if it continues to increase its size, definitely it is a substitute, and it's a substitute that's AAA rated, which is France is not even AAA rated right now. So I think if EU can just convince investors that we are giving you the liquidity in our curve, yes, it's a very good substitute. But I think that takes time, right? EU just started in 2020 with its shore issuance. Before that, it was a small issuer just issuing 10 billion a month. But, if you look at the Ukraine program, they are taking over all the issues of Euro area. So I don't think that they will ever stop issuing. The rollovers as well as new issues will always help that curve to build.
OK, excellent. I'm very glad we detoured into this story. This is very good. But I will go back to the GDP data we got out of the UK this morning, because it was much better than expected. And I wonder how the gilt market deals with that. We've got another, 21 minutes until we see gilt trade this morning. What does the front end do, seeing a print like that? A day after we got dovish lines from the BOE, we then get a hotter than expected print on GDP.
So I think one thing I would say that this GDP print was expected to be much higher, just given the fact, if you see last week, we also saw the Euro area GDP coming at 0.3%. So you are seeing that rebound happening in UK and Europe. Real wages are improving. The impact of energy is reducing. So I don't think that rebound will be seen in the next coming quarters. But for me, what the message that we got from BOE yesterday is important. So I think any sell-off, yes, a higher print is bearish for front end, but I don't think we rallied that much yesterday to actually create that kind of bearish price action. And we are basically pricing around 60 basis points in cuts for BOE, and that's not that much. It didn't match with the kind of messaging Bailey gave us, right? He was very clear that they are looking for cuts in the coming quarters, and they might have to do cuts much more than what markets are pricing. pricing. So on a cross-market basis, also on an outright basis, we do like being long front end. And I think to us, ultimately, it's like everything comes down to next week's CPI, US CPI. So I think that's where what will lead the next driver.
So that comes down to the US CPI print.
Unfortunately,
front end of the UK curve.
Yes.
So despite everything we heard from the Bank of England yesterday about not being the, beta to the Fed and going its own way or being more connected to Europe, this is still what matters, US CPI.
Yes, I think the extent of cuts that get priced in, I mean, markets have accepted the fact that ECB and BOE will go ahead of Fed, but how much they can cut and how effective these cuts will be when Fed is not cutting is a big question mark. So I think ultimately pricing in 3 cuts from BOE seems fair with the available information, but markets will be reacting to next week's CPI print.
When do markets start worrying about the fact that rate cuts are going to be a mistake, that they're going to be a policy error? Because, yes, they're going to still be taking us... We're not going to get out of restricted territory for a while, but nevertheless, this feels like an economy that's re-accelerating. How big a risk is there that inflation re-accelerates if we see rate cuts adding fuel to what looks like a decent set of numbers already?
So the thing is that at least for Euro area as well as for UK, at least we are seeing the deflationary trend. So which means that they can actually start cutting rates, not like any other cycle where we have seen consecutive rate cuts, right? They are just keeping the optionality, like let's do one, look at data, and then go ahead, right? So they don't want to go for consecutive because they know that's a risk as well. But I think if you see the domestic inflation drivers actually going towards the downward trend, which both BOE and ECB have highlighted, I think that is something that's more reassuring. But again, for me, the key risk when it comes to inflation right now comes more from the fiscal side, whether the UK election or the US election actually get that fiscal back that actually basically offsets the entire work central banks have done since 2022.
And what do you think in the UK context?
I think UK context... so far, I mean, Conservatives have not given us anything big. In March, they got an opportunity to actually provide us with big tax cuts, but it was a small package that they give. So I'm pretty sure ahead of the election, we could get a tiny package as well. But I think everyone is so scared of the Liz Truss events, and they would like to go into election where BOE is cutting rates and not talking about hiking rates. So I think I'm less... stressed about the entire fiscal situation in UK per se, and I think that's why I think even more, if you talk to clients as well, they are less stressed about UK election. I think more stress is about the US elections because we know their fiscal trajectory is just going higher and not lower, and I think that is the key risk that central banks may need to reconsider, that did we do any mistakes by cutting rates too early, and that is primarily for US.
Okay, so where does this leave us? What do we do? Do you buy the front end? What do you do with duration? What's the trade? I guess it's steepener is the right trade right now. Talk us through how I should be reacting to what you see in front of us.
So what we have seen in the general price action is like the front end can be pinned by central banks. So ECB has pinned the June cut, and BOE can pin the next cut as well. But I think the long end is more correlated to how treasuries move. So we have a 90% correlation in bonds as well as gilts to treasury moves. So I think if treasuries keep continuing going higher, again, it's a steepener trade that you said. So yes, we do like holding the front end right now. Given the fact that Euro area and ECB and BOE are ready to commit to rate cuts. Also the fact that we are pricing the minimum rate cuts right now. I think there has been a big move from where we started this year. So the sell-off coming from the front end is less likely. I think the next sell-off is more of a bear steepening than a bear flattening. So yes, we like the front end. We like holding gilts versus on a cross market versus either bonds or treasuries, because I think we will see that inflation, BOE will have 2 inflation prints ahead of the June meeting. And they will see enough evidence that they are actually on the right track.
OK, Pooja, thanks so much. Thanks for joining us. Pooja Kumra, Senior European and UK Rate Strategist at TD Securities. Thank you for being with us this morning. We'll look at your stocks to watch. That's coming up shortly. We will have IAG in focus after the British Airways owner says summer travel demand is strong. We'll dig deeper into those earnings next. This is Bloomberg. Welcome back to Markets Today. We are 12 minutes away from the start of cash equities trading, and the futures picture points a little higher this morning. Joining us now to talk about the markets in 2 minutes, Paul Dobson doing his best impression of Mark Cudmore, our executive editor, of course, for Asia Markets. Paul, thank you very much for being with us. Let me start with what's been going on in the US. Near records on the S&P yesterday. Interesting survey of investors says 52% expect the S&P to go higher by 10%, 48% they expect it to go lower. So the market seemingly quite divided. What do you make of where we are at this point?
Yeah, pretty split. But if you feel that momentum coming back into the market, you see the way that things are looking right now, then it might give you a little bit more confidence. We're within 1% of a record high. The data is interesting, right? The Citigroup Economic Surprise Index turned negative, but maybe that's not such a bad thing for equities, given where we are in that sort of bad news can be good news for markets kind of pricing dynamic. And if people are looking for signs in the data that will give the Fed reassurance that it can begin cutting later in the year, then maybe that all plays into a better looking picture for the market. It also seems that on the whole, the earnings have come out reasonably good. Okay, expectations weren't that high, but nevertheless, the market seems to be enjoying that kind of ride. So as we come out of earnings season, it does feel like there's a little bit of momentum back behind us.
OK, and talking about momentum, heading into next week, a really interesting Bloomberg scoop around China and the US and relationships there. The suggestion that President Biden is very close to deciding on further tariffs on an assortment of Chinese products. This is already having an impact on markets to some degree. What are you watching, Paul?
Yeah, so I think it's really interesting. There's going to be, everybody's expecting plenty of anti-China rhetoric ramping up into the election cycle. I think that the market is to some extent already immune to that. I was talking to our stocks team leader here. He was saying investors now are seeing as part and parcel of investing in China those risks. They're aware of them. They know what's coming or what's likely and how to deal with it, and a lot of it is already in the price. That said, you know, the threat of increasing tariffs is not going to be great for the companies overall. The argy-bargy that's going on with Europe over exports as well seems to still be pretty high after Xi's trip. It doesn't seem to have mended an awful lot. So that is something that the market is going to have to continue to keep on top of looking forwards into the future.
Paul, thank you very much. Paul Dobson, our executive editor for Asia Markets. You can find all of the Markets Live team, of course, as well as the occasional thought from Paul, perhaps, on the Markets Live blog. Should we focus on individual stocks, Guy?
We probably should. Jason's got his head in the clouds this morning. Let's talk about IAG.
Morning, guys. So IAG, the British Airways owner, reporting some really strong numbers in the last quarter and saying that summer demand is really strong at the moment. Importantly, we are seeing a lot of their planes now well above pre-pandemic levels in terms of how full they are. So this is the load factor, a fantastic chart. The load factor now at 83%, well above the levels we saw back in 2020 and 2021. If we look at that 1Q 2021, we were down at 46%, a time that none of us really want to remember. But we're back to those pre-pandemic levels now, and that should potentially help this stock outperform as it has been doing. A number of other peers like Lufthansa and Air France have warned on margins, given the worries about wages and industrial action. But IAG, for the moment, is the strong one in this sector. Though, if we do look against the longer-term chart, we can see still a long way to go for this one to recover, trading massively below that 2019 level. We can see still down around 45%, potentially more upside available on that one this morning. Then in terms of luxuries, we've got the fancy shoes out of Italy. It's Ferragamo, and this one looking much weaker. They are warning of some softness in sales, particularly in China. This is related to the travel downturn. There's those posh shoes, and they're looking great. And the 1Q revenue, we're at 227 million. That is below estimates. And as I say, the Chinese market, not very strong. Europe seeing a bit of an uptick, but we can see this stock has underperformed. It's more of the aspirational end, not the high end like your Hermes Birkin bag. So it is suffering with the downturn in the economy for Salvatore Ferragamo, potentially weak. Then from fancy Italian shoes to Italian tyres, we've got Pirelli. This one is potentially going to be a strong mover today. We've got numbers coming from the firm this morning. Continued volume growth and impressive margins is the view from analysts. Pirelli and Michelin actually outperforming the likes of Continental, who's more exposed to EVs. Pirelli more exposed to the traditional market, and that one is going to get some earnings upgrades according to analysts at Citi and Jefferies today. Most of the analysts are buy-rated, 9 buys, only a single sell. Pirelli could be strong in Italy this morning.
Tyres are just shoes for cars, Joe. That's the connection you want to be making there. Joe Easton, thanks very much indeed. Equity markets look like they're going to push higher again this morning. We've seen some really decent gains already this week. Looks like that's not going to come to a conclusion this Friday morning.
Yeah, absolutely. So looking for some modest gains across these European equity markets. Looking at the sectors from yesterday that did well, basic resources was one of those. And you know, that's a risk appetite story. And it's also to do with the China news flow, but it's also that M&A story. It's all of those themes that have pushed the markets, plus you add on earnings, higher, coming to bear in one sector. Autos were weak yesterday.
Also been weak all week. They've not had a good week. They're the underperformer. Biggest contango ever in copper right now. If you want to talk about what's happening with the basic resources market, Chinese smelters are selling copper back onto the front end of the market, which is kind of creating that mismatch. Further out, looks a little bit more normal. Anyway, we are going to get a positive open, it looks like, on equities. I'm fascinated to see how the gilt market opens this morning. Yeah, absolutely. I mean, the gilt market's kind of, according to one of our bloggers this morning, the gilt market kind of, and Pooja was saying as well, sort of putting aside what a lot of Andrew Bailey said yesterday, focusing instead on the US, and maybe the data we got out this morning kind of justifies that stance. Absolutely. Maybe that's going to affect that front-end story. We'll see exactly how the front end opens in a few minutes' time. We are about to see equity markets opening here in Europe. We'll get you the details of that, deal with some of the single stock stories as well. That's all coming up next. This is Bloomberg. Welcome back to Markets Today. A few minutes to go then until the start of cash equities trading. And the futures picture telling us we're going to make some modest gains at the start of trading here, Guy. We've got a little bit of geopolitics to put into the mix with the news lines we've been covering out of the US in relation to China and Chinese tariffs. That maybe doesn't touch the sides too much here in Europe. But in terms of where we are, the US session was pretty strong. On the back of some weak data, that impulse still remains intact. It is still sort of vexes my brain as to why the bad news is good news story, and I wonder when bad news becomes bad news. At some point, maybe that penny will drop. But this week has been sensational. It really has. We're not going to do the sensational six this week because Denmark is, or today, because Denmark is closed. But I feel I can use the word. The FTSE 100 is up by 3.2% this week, and this is over the last 5 days I'm giving you numbers for, so that's going to adjust in just a moment, in 1 minute. We've seen some really strong gains. These equity markets continue to power ever upward. We saw a little blip, but now we're back in terms of the upward trajectory. Gilts, bonds, generally this week have had a really solid week as well. It's risk on. Does that continue, and what upsets that narrative? Yeah, what does upset that narrative? We get inflation data out of the United States next week, and will that be, that'll certainly be something we'll cover in great detail, and it could be a piece of data that has wide impact, as we were hearing from Pooja Kumar a few moments ago. She thinks that's going to matter a lot when it comes to what happens here in the UK and in European markets. Back to the equities story, volume was a little low in the US, but we did close near those all-time highs on US stocks. About 5,200 on the S&P. It's felt like more of an earnings story out of Europe this week than maybe out of the United States, but there has been an earning narrative that you need to put into the mix as well. And you do kind of, that feels like maybe next week that begins to fade a little bit. So we'll be back maybe to trading all the macro. So here we go. European equity markets are about to open. We're anticipating a positive start, a continuation of what has been a fairly strong week. In terms of the numbers, the FTSE 100 out of the gate, as anticipated, with a fairly positive start to the day. Let me just see if I can get you some movers, and then we'll know exactly what's happening here. In terms of points, this is where the weight is, so I'm going to give you the weight numbers. LVMH, Shell, CRH, Sanofi, Total, all tracking higher. LVMH is adding the most points on the upside. I need to check my dividend list in terms of what we're seeing on the downside, because I do see Kuehne Nagel down by over 3% this morning. I have a strong suspicion. Yes, I think you're right with that one. That may be on the divvy list this morning. Yes, just pulling up that dividend list. Anna's always on it. She's got the list ready to go. Yes, Kuehne Nagel, you're absolutely right. We thank our colleague Dan Tillies for keeping us honest on that front.
morning after morning. In terms of where we trade across these sectors then, Guy, we've got energy as a really strong performer. It's dropping down the list slightly. Travel and leisure, actually, the best performing sector, and all sectors, crucially, in positive territory. So a sort of sea of green. IAG is one of those stocks that's doing well, up by 1.6%, though. I mean, not a blowout performance, but that helps to lift that sector, the travel and leisure sector doing well. Basic resources having another day of strength. You referenced, I think it was the copper price earlier on, and copper prices were higher through the Asia session, so maybe that gives another lift to the M&A story, which is clearly strong there. The M&A force strong with that one. And we've got the oil price going higher as well, up by 0.75%, 84.52. Perhaps that helping to lift the energy names.
May the 4th was a few days ago. That joke was a last week joke, not a this week joke.
It's very much a last week joke, and I probably didn't deliver it very well.
We're going to see exactly what's happening with gilts. We're keeping a firm eye on what is happening there. This following the GDP print we saw a little bit earlier on, which was much stronger than anticipated. I say much stronger. It was definitely stronger than anticipated, and confirms this idea that the UK is out of recession. Does it confirm this idea that maybe actually we do need to see maybe some rate cuts coming through? I want to check and see exactly what these numbers look like, because here we go. We're starting to get... Here we go. The UK is now open. So the front end, I mean, just readjust my screen so I can see what the 2-year is doing. Yeah, we are continuing to see things moving a little bit lower, as anticipated, and what we saw yesterday kind of confirming that idea.
Yes, I mean, not a huge move, is there, in the 2-year? But maybe that's because it didn't really move. This is exactly what Pooja said to us earlier, that the market kind of put aside Bailey's dovishness yesterday. This is the gilt market, and focused instead on the US, and therefore there isn't too much of that dovishness to unwind today with a hotter print on GDP.
Sam Brown was joining us earlier. This was his take on what we're seeing with the data.
In terms of trying to communicate that the policy reaction function is different, both the ECB and the Bank of England have done that, in my opinion, quite successfully. And I think there's good reason to. They have a lot more confidence than the Fed that policy is sufficiently restrictive. But in reality, the ECB is saying it's going to cut in a couple of months. Bank of England's potentially signalling it's going to cut in a couple of months. So if we get to June and they cut, then that's really going to show the market that they are happy to have that transatlantic divergence.
Sam Brown from BNP Paribas Markets 360 joining us in the last hour. Joining us now, Damien Hill, who oversees UK corporate bond, strategic bond and inflation-linked corporate bonds strategies at Insight Investments. Good morning.
Good morning. Thanks for having me.
Talk me through the market, how you see the market reaction to A, the Bank of England, and B, the data that we're seeing this morning out of the UK.
Yeah, so absolutely. A little bit of a non-event, kind of as expected. So 8-1 moving to 7-2. Dave Ramsden joining Swati Dhingra's cutting crew. And that band probably only going to expand over the next several meetings we have. So the area where we kind of disagree a little bit is those longer-term inflation forecasts, 1.9, 1.6, 2 and 3 year. Clearly, those forecasts further out pretty hard to make. And we'd see inflation remaining somewhat stickier, given the kind of newer impulses to inflation that we see in the medium term, whether that be more volatile geopolitics, with the UK being an open economy, kind of the dual deficit, current account deficits, as well as things like climate change. You've only seen that as well in the volatility and things like the cocoa price earlier in the year. Not saying that the UK is a massive consumer of chocolate and that's going to massively move things.
We are a massive consumer of gas, and that has been going up.
Absolutely. So there is that dichotomy there, clearly, with that medium-term inflation blue with the Bank of England coming down, but clearly this growth impulse is improving from that recessionary condition we saw later last year. Unemployment clearly rising, but from a low base, clearly not high in a historical context. Economic surprise indices moving higher, and you saw that probably with this GDP print this morning. So really some economic impulse there. PMIs still looking buoyant, and service sector inflation still elevated, and wage as well. So it's going to be tricky to balance those two narratives, and we see still our mantra is probably less in terms of cuts and later.
OK, less and later. So can you put some numbers on that?
Yeah, so we'd broadly be in line with the market probably for the rest of the year, so 2-3 cuts. In terms of it remains to be seen whether they go in June. We'll see clearly the inflation print's coming up in April, May the 22nd, I think the next one is. Absolutely. So that becomes important, and the data dependency, etc., could kind of change the timing of first cuts, whether the ECB or the Bank of England go first. But we expect those two to go before the Fed, as outlined by Bailey's comments. There's no right for the Fed to go first. But in terms of a terminal rate, we only dare forecast out 1 year, given the different kind of volatility you can get in all the indicators. But terminal rate by the middle of next year for the BOE may be kind of 6 cuts getting you to 3.75, something like that. So that's a little bit above consensus, that kind of later and less.
OK, so the cutting crew grows. Nice.
Absolutely.
80s rock band reference.
Absolutely, I thought I'd slip that in there for you.
Didn't escape my attention. Don't ask me about current music. But let's think about the corporate issuance landscape, which is, I know, one area where you focus. How much pain have we seen from the tightening cycle for UK corporates? How much of that is still to come? Or do they escape it? Did they lock in for such long periods previously during the sort of great moderation that actually a lot of them are unscathed by the hiking that we've seen?
Yeah, it's an interesting question. I guess for sterling investment-grade corporates, they have kind of pre-funded to a great extent. There is a large amount of the market, say, focusing on utilities that are constant need to issue. So clearly they have, the transmission of higher kind of coupons and costs of them comes through more quickly. But broadly, the supply in the sterling market is a little bit light relative to the demand. So we're seeing very strong technical demand for credit, higher yield environment. We've not seen these kind of yields consistently, these kind of levels, since the GFC and the tech bubble before that. So we're seeing a lot of demand from institutions and retail. There's a lot of, I guess, distortion, particularly at the longer end, in sterling credit from large institutional buyers, insurers, pension schemes. There's a lot of activity in the UK buyout market for DB, and that really only increases the demand as they immunise pension schemes and match cash flows, and they buy more credit. So there's a strong demand for UK credit further out.
So there's a strong demand for credit, and I guess if the GDP story continues as we saw it painted this morning, a quite positive trajectory for GDP, you're not too worried about defaults around the UK then?
No, we're seeing defaults as being pretty benign. One area in terms of as you go down the kind of rating spectrum where we are a little bit more cautious is with high yield. So you're seeing the lower end of high yield. Not that it's a massive part of the UK market. Real estate has been an interesting one. So you've seen certain names in the Scandinavian market fall through all the way from investment grade down through high yield, mentioning no names in particular. But so that's been a sector where you've really needed to get your stock selection right, and active management is key in these kind of areas. But in terms of the UK, a little bit less stress. It's not as developed high yield, but broadly we're much more cautious on high yield. Spreads are somewhat tight in our view from a risk-adjusted basis versus investment grade. So favouring an up-in-quality bias. Clearly, the lags of monetary policy still to come through. The Bank of England was stressing maybe 2/3 of it starting to come through in the UK. So, there may be some pain down the road in lower ends of the parts of the high-yield market. But IG, largely unscathed. It's not really a default story.
Let's come back to those lags. There is a conversation just beginning about when the next hike comes from the Bank of England, about how you need to think about how this cycle is going to evolve and how far, to your point, maybe the cutting actually goes, and how long the lag will be from the kind of the final cut to the first hike. Is that conversation beginning to become relevant? Am I too early in thinking about it?
Yeah, I think it's a bit early, certainly from our discussions. Clearly, the kind of thinking about whether the next move might be a hike is more prescient in the US, I guess. That's certainly been something more in the narrative.
Yeah.
In terms of in the UK, I think we're way away from thinking about when the next hike might be, certainly in our internal discussions. So it's all about how far they cut at this stage, and clearly we are a bit...
And presumably how far they cut determines how quickly they're going to be hiking as well. If they cut aggressively and the economy proves to be more resilient than maybe than anticipated, the first hike becomes maybe more germane in terms of what we need to be talking about.
Absolutely. So hence why we are later and less, because we think the economy is improving. Our risk models are saying ultimately the impulse for growth more broadly is pretty decent. So, yeah, we're not advocating, massive cuts and back to anything like what we were seeing pre-COVID in terms of, or around COVID in terms of levels of
I was going to ask you that, that great moderation and that period of very low rates, a lot of people concluding that this is a different era and we shouldn't expect to go back to anything like those levels. So what kind of rates do we settle at in the UK?
So, as I say, in terms of our forecast period, terminal by middle of next summer, maybe 6 cuts getting us to about 3.75. Is our view. So we're not forecasting out further than that. We think it's a bit of a fool's game, 2, 3, 4 year. But, yeah, we think that's probably a cut or so higher than the market, or less cuts, so to speak. Right.
And how restrictive would that be? I'm just trying to think of what kind of impact that's going to have on the parts of the UK economy that have not been thriving, because there've been some doing fine, but others, I'm thinking of real estate here, not doing so well.
Yeah, no, absolutely. I think it does remain to be seen. Clearly, if you take the Bank of England stance on those inflationary kind of medium terms, they expect, given that directionality on a domestic impulse, for that to be restrictive. So, yeah, in terms of real estate probably is an area that might suffer a little bit, given higher for longer in terms of rates, and that's our expectation. But clearly there is that supply-demand. If you think about resi in the UK, there's always never enough supply. So, you know, it's always been the full game waiting to buy a property, for instance, or from your domestic side of things. So, yeah, look, I think medium term, the expectation we would agree with from the BOE, they need to maintain that restrictiveness to get inflation under control.
What's the maximum spread you could see Bank of England to Fed? How far kind of down the road can they go?
Yeah, I mean, our forecast at the minute, we're seeing kind of 3 or 4 cuts about a year out from the Fed. So given that, that's kind of, you know, 3 or so cuts different. Clearly, they're quite close in terms of where the bank rates are at the minute.
Yep.
So something like that as a maximum. Clearly, the UK currency, there's quite a lot of negativity built in post-Brexit. So we don't think if they diverge or they go first, you're going to get a material move in the currency with it already being somewhat depressed longer term.
OK, Damien, thank you very much. Thanks for joining us. Damien Hill, Senior Portfolio Manager at Insight Investment. Let's focus in on one of the corporates that has reported numbers this morning. IAG shares are up after the British Airways owner reported that high demand for travel has been a continuing trend. Let's get more with Bloomberg's Sid Phillips, who's, of course, covering this sector for us. So, Sid, what bright spots are IAG flagging? What have you found?
So IAG has been flagging the fact that they have very strong transatlantic performance, as well as the fact that they've got very strong intra-European performance. IAG is the owner of British Airways, Iberia, Aer Lingus, and other carriers. And so they have a very strong transatlantic presence, both North America and South America. And they've sort of been flexing that advantage and talking about how that demand is really strong as they go into the crucial summer season.
Sid, O'Leary was cautious on the summer season. IAG sounds more positive. Is that the right read?
That is. I mean, O'Leary was less confident about pricing power in the summer season, but IAG is talking about how demand is strong. And they've said that about 80% of their second quarter bookings, forward bookings, are sold out. And they're about 40% sold out for the third quarter. So they do seem to be far more confident about demand in Europe this summer. And so I think that's really a sort of divergence in terms of where O'Leary stands and where IAG stands, really.
Sid, why the difference between, is it just the North Atlantic, between what we're seeing at IAG and what we're seeing at Air France and what we're seeing at Lufthansa? Why is IAG seeing a different picture?
So IAG is sort of telegraphing the fact that they are less exposed to both Asia as well as the Middle East. And that gives them a slight advantage over Lufthansa and Air France that do have a lot of services to the Middle East and to Asia Pacific, where competition is rising back again. I mean, we've seen the rise of sort of carriers both in Asia Pacific coming back from the pandemic, and that sort of brought in lots of capacity. And so pricing power isn't as strong on those routes. And so IAG is sort of saying that, hey, we're on the transatlantic route where we see demand continuing to go gangbusters.
Sid, great stuff. Thank you very much indeed. Sid Phillips joining us on what we're seeing out of IAG this morning. We're coming up to IATA. There's a lot more aviation news coming up over the next few weeks. Looking forward to that. Let's get back to the shoes story, both for cars and for people. Joe Easton, back over to you.
So firstly, with the shoes in the car space, Pirelli, the tyre maker, this one gaining 2.5% at the open, coming down slightly now, volume growth continuing, the margins looking pretty good, not exposed so much to the EV space, which is where we've seen some warnings recently, but that one is higher. Salvatore Ferragamo, though, that one actually not doing too badly, down 0.2% at the moment. It has fallen a lot recently, given the downturn in some of the smaller luxury stocks. The earnings didn't look great, but they are saying potentially there has been a little bit of a rebound in Europe throughout the spring, so that might be supporting the stock, taking the edge off there. In terms of utilities, they are having their worst quarter versus the main market for around 20 years, according to an analysis I read yesterday. And we've got numbers out from Enel today over in Italy, and that stock coming back up around 2.5%. And finally, on the Italians, we've got Mediobanca, a massive jump in net interest income for that one today, so that one's getting a decent gain, one of the best performers. In terms of some other earnings, we do keep an eye on CRH. They've moved their main listing over to the US, but they've still got the London listing as well. It is the construction company that's seeing strong gains in North America, and that one up 2.7% today. But going the other way is Rightmove. We've reported earlier in the week the drop in house prices, and they are seeing fewer houses coming onto the market, and that is negative for the property portal. So Rightmove down 2.7, actually down 3.5% now, still extending those losses. Melia Hotels, though, a bit more positive news. They're seeing strong bookings for the Spanish hotel group into the summer, and that's getting a gain today, similar to what we heard out of IAG earlier around those booking numbers doing pretty well. We've got a deal over in the defence space. Leonardo is offloading its submarine business for around 400 million euros. This is to Fincantieri, which for them is negative because they're funding it for a massive capital raise, 400 million euros. So that one is declining. Leonardo getting a bit of a boost. And breaking news earlier on Vodafone, their deal to merge with 3UK, their UK businesses, has actually been approved on national security grounds by the UK government. It still faces a CMA probe on antitrust, but on security grounds it is approved, and it's boosting that one. We've brought up Sabadell. We're keeping an eye on that one. Got a takeover bid at 2.1 euros, of course, but they're out today saying that they don't like the way that BBVA has gone about this. They're complaining about some of the meetings and publications on that. That stock coming down 0.2% this morning. We'll take a look at chips, though. TSMC, a huge gain in sales, according to that report earlier today. But we did also have earlier in the week the warning from Infineon that sent that stock plunging, and perhaps that is a bit of an overhang for the sector. A pretty mixed performance for those. ASML up 0.8%, BE Semi as well. ST Micro lower very slightly. Just one morning call to bring you Zalando. This one is a buy over at Berenberg. Zalando reckons we're all back online buying clothes for the spring season, the spring party season. They said that earlier in the week, and Berenberg reckons you should buy into that trade. That one's getting a nice boost on that rating change. It's up 3.4% for Zalando in Germany.
Spring party season, is that a thing, Joe? I take your word for that. Don't know where my invitation is.
Yeah, I'm into it. I'm into it.
Thank you very much, Joe Easton from our equities team with all things clothing and beyond. Coming up on the programme, the US poised to impose tariffs on China EVs as soon as next week. More on that Bloomberg scoop. That's coming up next. And also on the EV theme, Bloomberg's Oliver Crook is at a racetrack in Berlin. Oliver, you're not just there for fun, of course. You have a big interview coming up.
That's right, Anna. We're at the Tempelhof Airport, the historic airport here in Germany. You can hear some of the noise because it's also the pit lanes now for the Formula E race that is going to take place over the weekend. Formula E, really a new sport, only about 10 years old, really trying to compete with Formula One. And here you can see everybody is getting prepared. And we're going to speak to the CEO a little bit later about really building this business, building a fan following for this sport, and really how to compete with the incumbents like Formula One. That'll be later. This is Bloomberg.
I think firms need to recognize two things being true at the same time. It is a large market with large potential, but at the same time, there are certainly factors at play, many of which geopolitical, that should give companies a moment of pause.
That, of course, is the Citadel Securities CEO Peng Zhao talking to Bloomberg about the challenges investing in China right now, and we continue that conversation. Bloomberg sources understand now that President Biden's administration, we think this is going to happen next week, will unveil fresh tariffs on Chinese EVs and in other key strategic sectors as well. We think this is going to happen next week. Timing's a little bit kind of speculative at this point, but this is a near-term story that you're going to have to factor into your thinking. Joining us for more on this scoop is Bloomberg's Asia transport reporter, Danny Lee. Danny, just talk us through exactly what these tariffs are going to look like and how far they're going to go, and why are we talking about it now?
Yeah, this has been in the running for a while, a 2-year review by President Biden's administration, and particularly in an election year, someone like President Biden has to set out his stall, in particularly where the rhetoric from someone like the Republican candidate Donald Trump, who's calling for across the board 60% tariffs on all Chinese imports. Now, this is President Biden setting out his stall on at least three key sectors, which clearly cause the most concern: on electric vehicles, on solar, and on batteries. And so therefore, we are expecting to see a significant tariffs put in place, but unlike Donald Trump, who wants to see across the board, this is more targeted, more measured, and it's very much focused clearly, when you talk about the election, in areas where the automakers in the US are under serious pressure from Chinese EV makers overall. And so therefore, when you look at where production is in the US, clearly in a lot of swing states. So it's a fascinating thing to see that could play out as soon as Tuesday.
Yes, the politics clearly hanging over this in an intense fashion then, Danny. How might China respond? I was looking at the Ministry of Finance briefing this morning to see if there was going to be any response on that front. Nothing too obvious, but maybe you spotted something.
Yeah, I think this is a key thing to see how China will respond. And we can just look back to how China reacted specifically to President Biden, his announcement a couple of weeks ago as well, that the US would put tariffs on Chinese steel and aluminum. And so whilst China was clearly very angry with that, we haven't seen a specific response yet. And until we see on Tuesday what the US is prepared to unveil, we just have to watch and wait. And clearly, Chinese EVs are not getting into the US anytime soon.
Danny, thanks very much. Bloomberg's Danny Lee in Hong Kong. Really fascinating story then, emanating out of the White House, Biden and what he plans to do next week with regards to tariffs on Chinese product. But there are all kinds of other China threads to pull together. And today we got this survey by the EU Chamber of Commerce in China saying only 13% of those businesses that are European doing business in China see China as a top destination for investment. And that's the lowest since 2010. So we've certainly fallen a long way.
So big German chemical companies have made massive investments in China over the last few years. The danger now is that maybe some of those assets end up looking stranded. The geopolitics makes them more difficult. Clearly, there's going to be huge demand for chemicals in China, but this kind of big footprint that German industry developed in China, I wonder whether or not there's maybe some kind of rethinking of that strategy. And this speaks to it. Do you just go elsewhere in Asia? Or is this a wholesale retrenchment from the region? Yeah,
and in some sectors we have seen that, haven't we? So not investing in China perhaps, but investing in Vietnam or Indonesia or places, other places in Asia. It's interesting that certain businesses in some sectors, and I haven't heard much in the last 24 hours from the chemical sector, but certain businesses we are seeing some pushback, or at least a search for clarity, if that's even possible, in an election year. We played some sound earlier from the Snap CEO asking for just some clarity on this.
Yeah, I think that is wishful thinking. I think this is a moving target. This is a geopolitical situation that is developing really quickly. The Ukraine war's made it more complicated. What's happening in Gaza is making it more complicated. What's happening in the South China Sea is making it more complicated. And the election is making it more complicated. Clarity is not something that I think is going to be, we're not going to be seeing a great deal of.
OK, we will keep an eye on that story, of course, for you. Coming up on the programme, we take a look at the UK's better-than-expected GDP figures and the impact on rate cut bets. We'll talk about that. The transatlantic flows in focus as well. This is Bloomberg.
Friday the 10th of May, little recap. We are 30 minutes into trading here in Europe. Let me tell you what is happening. Bonds are bid. We've seen stronger GDP data out of the UK today. But let's turn our attention to what is happening with the equity market, which has had a really strong week. European equities continue to climb higher. They gapped higher first thing this morning. We're not talking about big gains here, but they are incremental gains over the course of the week. And so let's flip my screen here a little bit. Basic resources are driving it this morning. Utilities are up. Energy's up. That's not exactly a growth-orientated mix, but nevertheless, we are seeing positive numbers being posted. In terms of what we're seeing on the week, let me just give you a 5-day number, just so you know kind of what you've been seeing throughout the course of the week. It's always nice to keep track. So a gap higher this morning. The Stock 600 is now up by nearly 3% on the week, 2.8% so far this week. That's a decent gain. And it's not a bad gap higher this morning either.
OK, and I was just going to look at the sectors over 5 days as well, because that can be useful. Again, though, to your point about today's session, with utilities not doing too bad, that's the best performing sector over the past 5 days in Europe, across Europe. It's the utilities story, which doesn't tell you a great, risk appetite story.
Doesn't scream growth, does it?
It doesn't, no. But construction and materials not far behind, and industrials and technology and energy. And actually, to your point, most sectors, nearly every sector in positive territory, apart from
the cars.
Yes, autos and auto parts.
Cars have had a really bad week. All of the numbers.
Cars and their shoes, as they will now be known.
Car shoes. You want to buy the car, you want to buy the right shoes for the right weather.
Apparently so.
Yeah, I try to explain this to various people. Nobody ever really listens to me. Should we talk about the UK GDP data as well? Because you're certainly seeing a little bit of reaction there in the gilt market.
Yeah, absolutely. So the bond market's digesting a better-than-expected print on GDP. Britain has bounced back from a shallow recession with stronger-than-expected GDP numbers for the first quarter and for the month of March. The data provides some relief for the Prime Minister, Rishi Sunak, perhaps, but may temper the market's enthusiasm for a June rate cut. So there's a lot to put together here. Let's bring in to the conversation Sam Unstead from the Markets Today live blog and Anna Andrade from Bloomberg Economics. Anna, if I could start with you on the impact of this data. It's interesting, I suppose, as a narrative for the Bank of England when it goes out there and tries to explain to the country what's happening here. We're getting closer to rate cuts, and yet we're seeing this data bouncing back and we're coming out of recession. Is there a mismatch in timing there? How will that fit for you?
Yeah, I think on the surface it might seem like a mismatch. And if you look at the headline number, it was quite a strong GDP outturn. We in the Bank of England and consensus were expecting growth of 0.4. It came in at 0.6. That's a big surprise. But actually, the question now is whether the growth will remain at this pace and this sort of high growth trajectory will be maintained. Our view is that it won't, and we're a bit skeptical, and today's data doesn't really change this view, because when you start looking at the breakdown of the GDP data, you actually see that a lot of it was driven by net trade. And within net trade, it was a fall in imports that sort of added to growth. And when you look at domestic demand, that has only grew by 0.2%. So it hasn't even recovered to the pre-recession level, let's say. So in a way, when you look at the components of the economy that are being affected by interest rates, that's still pretty subdued. So in our view, we just don't think that, this is going to translate into higher momentum.
So it isn't as strong as it might at first appear then, this GDP print. And tell us about those sectors that are struggling right now, still coping with the higher interest rate environment, even as we talk about lower rates. That hasn't happened yet.
Yeah, no, definitely. I think the fact we are expecting rate cuts this year, we think the first rate cut from the BOE will come in June, and that will provide some relief, and there will be sort of growth drivers this year. We had the easing of financial conditions, we have the fall in energy prices, some income taxes, and that's all going to add to growth. But I think the main thing to consider still is that monetary policy will still be restrictive. So any sort of pickup on the growth that you're going to expect will be limited.
Sam, why have the markets in so many ways have been muted in their reaction to all of this? You've got a Bank of England that is sounding quite dovish, yet the market's barely budged. The bank's trying to distance itself from the Fed, but the Fed US data is having a really big impact in terms of how we are positioned here in the UK. Is that something that when you talk to people, they're expecting to change, or is this basically something we're just going to have to, and the bank is going to have to live with?
Yeah, I think this is something that the bank's going to have to. I mean, actually, it's interesting. So I agree with Anna. I think the markets agree with Anna as well. Yep. Almost nothing moved today on the data. So yes, the headline looked a little bit stronger. That could, if you're just looking at that, might raise some questions about strength of the economy and that leading into the Bank of England. But I don't think it does really. I think at the moment, the wage data we're going to get next week, and then the inflation data we're going to get the week after that. That's where we'll really get to understand the Bank of England's thinking.
Is the Bank of England overly focused? There was a question, I think, in the press conference about this yesterday. Is the Bank of England overly focused on the inflation data because the labour market data is so rubbish?
Yes, I think you could probably say that. Yep. So with the labour market data in particular, so when we're talking about being data dependent, and the Bank of England is talking about being data dependent, you're not just talking now about those official figures, because not till September you're going to get the labour force survey through, guarantee that it's going to be perfect then. So you're looking at everything else. And actually yesterday, for example, we had the REC data, the REC KPMG data, and that showed again the same sort of trends. Permanent jobs going down. The market is sort of loosening, but wage growth still remains quite strong. So I think for the inflation data too, the really, really important part, again, is going to be services inflation. If that remains really sticky, then that could start to change the picture a little bit. But really, I think June looks like it's very much now on the table, and it would take quite a big surprise now to prevent that being the case.
It's really interesting, isn't it, looking at the wages story? I mean, even the Bank of England is expecting that wages, we're going to get real wage gains this year, because inflation's at 3% or so, and wages they're forecasting will run at 5.25% this year. So that's quite a chunk above inflation, and you wonder how much that changes that recovery trajectory. Interesting that it hasn't been, as Anna said, the positivity hasn't been driven by the domestic economy yet, but maybe we get a bit more of that. And I wonder how that changes or threatens to change the politics, perhaps.
Yeah, it may do. I mean, I think, so the wage growth figures, so like as guys sort of alluded to, the official jobs data isn't enormously useful right now, but the private jobs data is, and I think, again, that REC report yesterday, it shows, permanent hiring is slowing, but the wage growth is still going up because of this structural mismatch between skills. That is not going to go away anytime soon, so that's going to have to remain part of the thinking. But again, I think what you're going to need to see is a pretty significant upside surprise now on either wages or inflation or services inflation to really, really change the conversation.
Anna, how far out can we look with the UK economy? Like, how much visibility do we have in terms of our understanding what we're going to look like in a year's time? How long will this cycle last? When we finish this cycle, how long does the kind of the floor last for? How long before we start hiking again?
Yeah, I think what's determining a lot of the business cycle right now is interest rates. So we had this big shock in interest rates that's weighing on the economy, and any sort of growth or recovery that we're going to get, cyclical upswing that we're going to get in the next few years, will be just sort of on the back of a reduction of rates. Yeah. And then the big question is like, okay, what's the supply growth of the economy? Where are we going to settle? And then I think it's also not very optimistic. I mean, we know that the UK has sort of, problems with investment, with productivity, and now with a limited labour supply. So overall, we think...
We're geared for a pop back in inflation, basically, if the productivity story doesn't improve and growth picks up.
Yeah, I think things are not looking... It's not a major risk to inflation because supply growth is still going to be sort of very low. Yeah.
Anna, tell us update us on the linkages between the UK economy and Europe and the US and where the emphasis should be, because obviously the Bank of England tries to push back on the idea that we're connected, more to the US than Europe, and that's been... We've seen some of that translation from the Treasury market into the gilt market. They didn't want to see that necessarily. So we see some pushback there. But then, I mean, this is a totally different sector. But you look at the IAG numbers this morning. It's all about transatlantic demand. It's all about, one assumes, linkages between one big financial services market and another. And if M&A starts to come back, I just wonder, where is the external factor to watch, I suppose? Is it the US or is it Europe?
I would say it's probably mostly Europe. I think in terms of growth, the story in the UK, it's much similar to Europe than to the US. So we've had a recession. We've been sort of in a state of stagnation for the past 2 years. Monetary policy is clearly having an impact, and that sort of has been the story in the euro area. When you look at the inflation dynamics, that's where you kind of pause a bit and you think, actually, services inflation and wage growth is very high, is much higher than in Europe, so maybe we're more similar to the US. But actually, we actually think that the inflation dynamics are also changing and are also becoming much more similar to Europe, because we're going to get this fall in energy prices. Europe is also experiencing a disinflation in energy. And when talking about these persistent components that you mentioned, services and wage, they are high. But the expectation is that they will fall once headline inflation falls, because if you have headline inflation sort of hitting 2%, then inflation expectations adjust. And so people don't go out and ask for higher wage growth, and then services inflation also moderates. So it's sort of like a chain of events that will happen. And I think what the BOE sort of needs to see first is headline inflation getting to 2%. And in that sense, we're just much more similar to Europe than to the US. We're much closer.
In terms of services inflation, this makes my mind go to another Bloomberg story this morning.
Anna's been talking about this all morning. She's been waiting to talk about it. It is making her blood boil.
No, I thought of something measured and sensible to say.
Why?
Well, it's all about tipping, basically. Some of our colleagues have written a great story about how there's increasing emphasis on tipping in the UK, but is specifically in pubs. And so this is when you go to the bar and you order drinks and do you tip. And I don't know what your experience is, Sam, but it feels as if the dynamic here, the social pressure has changed here a little bit.
No, I think the technology has changed.
Well, exactly. So this was the sensible thing I was going to say about how tech intermediation has changed the culture. It has. Because you'd never get a bartender give you your drink, say, that's, £5, £6, and would you like to tip me? They never would say that, would they? But they'll pass you a machine.
Anna, when did you last go to a pub when they said £5 or £6? Was is that just... That's 1 pint. That's less than 1 pint.
Well, yeah, there we go. I was reaching. But the point was, they wouldn't ask you for a tip, would they? But the machine will.
The machine, because it's easier, because you're just tapping on it, it has the little program that comes up, but this comes back to the wage story, because I have to say, friends of mine that run pubs talk about how difficult it is to attract wages at the moment. The legislation is going to change so the staff get all of the tips soon, and this is a way of the big pub chains in particular basically dealing with their wage bill.
Yes.
And because they're struggling to attract people and they're struggling to pay people, and the margins are so small now, taxes have gone up, etc. So I think this is basically part of the wage story rather than a technology story.
I'm sure there is a sensible wages story in here, Anna.
Sure.
I'm not sure what it is, but there is one. Anyway.
Do you know what tipping stands for?
No, enlighten us.
To ensure promptness. So that's what it goes back to.
Right. I had no idea it was an acronym.
So it's TIP rather than tip.
And where did it originate?
I think it was back in the 1600s or something. Basically, so you were giving money precisely, in Europe, you were giving money to the barman to ensure that he gave you your pint quickly.
OK, I did not think it had involved here. But that's new information for me. Thank you very much for taking us there,
that's me trying to be sensible as well.
Excellent. Right, we will move things on shortly. Thank you very much to Sam Unstead from the Markets Live blog. And also, in fact, no, from Markets Today blog, to get that correct.
You want to get that name right.
Yes, and also to...
the name of the show.
And also to Bloomberg Economics, Anna Andrade. Thank you for joining us. Coming up, we will be heading back to Berlin. We saw him earlier, Oliver Crook enjoying himself far too much in the pit lane. Bloomberg's Ollie Crook is on the ground for us. He's having a nice time on the racetrack. He also has a great interview lined up for us, though. The CEO of Formula E will be speaking to Ollie shortly. This is Bloomberg.
Friday the 10th, we're 46 minutes into the trading day here in Europe. Stocks are generally bid. As you can see across the piece, we are looking at some fairly decent numbers coming through, and this builds on what has been a fairly decent week as well. Bonds actually have been fairly well bid too, and it's interesting to see the reaction this morning to the data that we are seeing out of the UK. But it is the weekend, so we should talk about sport. Obviously, many people are focusing on what's happening with the Champions League as we start to see the finalists being confirmed, and we'll continue to watch, obviously, what's happening with the football. But the racetrack is also of interest this weekend. Formula E is now in its 10th season, and as the sport grows in popularity, questions are being asked about the championship's carbon footprint and net zero targets. Let's find out more. Ollie Crook is at the Formula E circuit in Berlin and joins us now.
That's right, Guy. We are here at the Formula E circuit where we're looking at Tempelhof Airport, really steeped in German history, but really containing today the future, potentially, of automotive racing and Formula E. I mean, you can see the cars behind me just getting lined up there. And these cars, there's such a rate of change in terms of the technology going into these things. You know, acceleration from 0 to 60 in 1.82 seconds, faster than Formula One on that point. But where does this go as a business? How do you build a fan base? Well, we've got the right person to ask that question to. It's Jeff Dodds, the CEO of Formula E, who joins us now here at the race circuit.
Good morning. Welcome to Berlin.
Yeah, thanks so much. So listen, where are we right now on the journey for Formula E? We're 10 years in. You're 1 year into your tenure. Where do we stand?
So that's right. So Formula E started just 10 years ago, so we're effectively babies in the world of motorsport. Yeah. If you compare that to something like Formula One around 75 years old. So we're at the start of our journey, but of course we have this wonderful tailwind, of electrification. When Formula E was started just 10 years ago, I think that year there were 300,000 electric vehicles sold across the globe. If you compare that to now this year, the estimate is around 18 million electric vehicles will be sold this year. So whilst it feels like we're still at the very early point of our journey, around 20% of all cars in the world sold are electric at the moment, we still have that kind of 80% ceiling we're pushing for.
Right, and part of that journey is going to be for you defining yourself not as just an alternative to Formula One. So how do you make it not the sort of beyond meat of Formula One? How are you positioning for that?
Yeah, so obviously everybody speaks to me, they speak to me about the comparisons with Formula One, which is perfectly logical because we're a world championship. We're single-seater racing cars, and we're racing on tracks. But when Formula E was founded, it had three principles. One of those was to be an elite world championship racing series, so it was all about racing. And we would argue quite strongly we have the most competitive racing series in the world right now. But the two other ambitions were, one, the tech transfer, to develop latest electric vehicle technology, so to be at the cutting edge of EV technology. And you see here racing today our manufacturer partners. So you see Porsche, Jaguar, Nissan, Mahindra, Stellantis, ERT. You see manufacturers, and they're developing tech on the racetrack that will make its way into their road cars. And the third thing we founded for was sustainability. So we wanted to be a platform that could educate the world around climate change and the role that electric vehicles can play in decarbonising road transport. So three things.
And so, I mean, the rate of change has been absolutely breathtaking in the sport. I mean, you've doubled the horsepower in 10 years. The new car you're putting out at the end of the season is going to go, accelerate 30% faster. I mean, these are really breathtaking sort of changes in technology. What more is coming? What does the sport look like in a couple of years?
So the really simple answer to that is when you look at the car development, longer, faster. They're the two things people want to see. So today the racing in Formula E is about 40 to 50 minutes long, which actually is really interesting because it's really good for family viewing. So we're attracting a different audience to traditional motorsport, like Formula One, where the race is about an hour and a half long. But we want to have the ability to race for longer in the future, and that means batteries with bigger capacity. And the second thing is faster. I mean, this is a motorsport. Everyone wants it to go faster. So you're right. We announced the car that will be on the track for next year will be 30% faster than the current Formula One car, 0 to 60 in 1.82 seconds. But also people like a bit of top-end speed as well. So these cars you see behind you here will go about 200 miles an hour at the top end. Over time, I would expect to see that go to 220, 230, 240. So the cars are getting faster, the batteries are getting bigger.
So here's the question. Will it ever be faster than a Formula One car?
Well, it's already faster than the Formula One car.
In acceleration.
But if we want it to, and I think one of the interesting, obviously for Bloomberg viewers who are very interested in business, one of the key things is the economic return on investment. So if you think about Formula E, the cost cap in Formula E, so the amount these teams can spend every year is around 13 million euros. That's all they can spend. If you compare that to Formula One, where the cost cap is about $140 million, so they have around 10% of the budget to play with. So of course, if I gave them a budget of 140 million euros, they could develop cars that would go much faster than Formula One cars with electric technology. But the reality is we view ourselves as an inclusive motorsport, not an exclusive one. This is not about the richest organisations in the world taking part. We want everyone to benefit.
Presumably you want to grow your sponsorship, you want to grow that base, you want to get more money in because it will bring more fans and it'll be a virtuous cycle.
At the right pace. We need to support our manufacturers here because a lot of them are using the racetrack as a laboratory to develop new technology. So it's about manufacturers and teams, it's about growing a fan base, and that's growing very quickly, as you mentioned up front, and then it's about growing the total value of the organisation. But
where would you like that to be? Where would you like to see the total value in the next few years?
Well, so we don't talk about our value today publicly. We have two very large investors in Liberty Global, Warner Brothers Discovery. But as I say, this is a business that's only 10 years old. So they're investing for what they believe the future of this business could be. I think fan base, though, is a good proxy. So when I started about a year ago, the fan base in Formula E was about 290 million fans globally. As of now, the latest time we did the big survey, it was up to nearly 400 million fans. So around 30% growth in a year. This is a business that's growing exceptionally quickly.
And in terms of the other thing that you need to do is also attracting other OEMs, other manufacturers to the sport, right? There was Mercedes, BMW, they stepped back. What I'm surprised by is that there are not more Chinese automakers fully who have really dominated the EV race. Are you in conversations with them?
Oh, yeah, of course. So you have the big Chinese automotive groups. So BYD now becoming prevalent across the world. In fact, I think the biggest EV manufacturer now in the world. You've got Geely Group.
Could you see a BYD team in the next couple of years?
I could absolutely see a BYD team. I could see a Geely Group team like Lotus or Zeekr, SAIC, who obviously own brands like MG across the... So absolutely I can see a Chinese team. We actually have two Chinese teams here. We have ERT, but we also have Envision.
What about a Tesla team?
I think Tesla's unlikely, and I'll tell you why I think it's unlikely. So all of the teams here are racing on a common battery. So I'm not sure that Tesla would be so keen to run on a battery that isn't their own. The second thing for Tesla, I would say, is they are the dominant force in the electric vehicle manufacturer. They were the people that started it all pretty much with the Roadster. I'm not sure, they don't need the exposure, so they don't need the PR around it. And the final thing I would say is a lot of the teams here have been racing in Formula E for a long time. Tesla would not be competitive from day one, and I'm not sure how that would fit with
that. That sounds like a challenge to Elon Musk, which is always a dangerous thing to do.
It's never dangerous. I would love Elon to call me. I'm just not sure it will be top of their list.
And in terms of your fan base, and obviously growing a sport almost from scratch, where are you seeing the biggest pickup? Where are your biggest fans? Where are you the most successful right now?
So Southeast Asia, across China, we have over 100 million fans in China alone, so growing incredibly, to your point about the Chinese EV market growing. But our fan base is very different to motorsport traditionally. So if you think about our fan base, roughly split 50-50 male-female. That's incredibly different to motorsport. Roughly half of our fans are under the age of 40, and they all have an interest in climate change, sustainability, innovation and technology. So it's quite a different audience. So whilst it's growing quickly, it's growing outside of a traditional motorsport base.
Jeff Dodds, thank you so much. The CEO of Formula E joining us here at Tempelhof Rafah Airport, the racetrack that's happening, the race happening this weekend, Saturday and Sunday, starting at 3 p.m. tomorrow. And as you can see, all the cars getting prepped and ready for the race tomorrow.
Oliver, thank you very much. Really interesting conversation. Bloomberg's Oliver Crook in Berlin talking Formula E. What else is on the agenda today? That's for your weekend, of course. But today, before we get to the weekend, we get 11 a.m. UK time. We'll get an AGM from Standard Chartered. 12:30 London time. The ECB publishes the account of its April policy meeting. How certain is June? What does the data look like in the run-up to June? At 3 p.m. UK time, University of Michigan consumer sentiment out of the States. And we're looking at a whole host of potential sovereign rating changes. We'll keep an eye on those. And finally, central bank speakers. There's plenty of them, Guy. We hear from a lot of Fed voices and a couple at the BOE as well.
Yep.
Swati Dingra, Hugh Pill. Both of those will be out speaking a little later on today.
Yeah, and you can expect some more volatility around some of those comments that we get from those central bankers. And in some ways, that's part of the problem, trying to kind of see through the noise of all these central bank speakers.
And there's also an IPO you're watching, Zeekr.
Back to the electric car story.
Yes.
So Chinese company, high-end Chinese company, potentially listing in the United States a little bit later on at a much reduced valuation, which speaks maybe to this idea that, A, the challenge at the moment within the electric car industry is enormous in terms of the price discounting we're seeing, but also the geopolitics that we're going to hear more of next week, potentially Tuesday, Wednesday from the Biden administration around restrictions of Chinese cars coming into the United States, the second kind of leg to that stool.
Something else that is on our radar very much for next week is the Qatar Economic Forum. This is
how many hours is it to go?
Powered by Bloomberg, and it's taking place in 3 days, 22 hours, 4 minutes and 12 seconds. Just to be precise, in case you need that level of precision from us, it's available on our website. There you are, a countdown clock to the Qatar Economic Forum. But in all seriousness, energy transition and the geopolitics, 2 of the 5 sort of editorial pillars of the 2024 event, another one being sport. You can't go to that region without thinking about the business of sport, it seems.
Next week's going to be dominated by the CPI data out of the United States. That's the kind of the pivotal story that we're all waiting for. There's a big conference taking place also in Paris, just outside Paris at Versailles on Monday as well. This kind of Invest in France forum. I suspect we're going to hear a lot of voices coming through from that as well. We'll see exactly what that delivers from some of the big bankers that are going to be attending that event. But next week, it is CPI week.
3.4%. Is that what you're looking for? That could be the number to introduce the week. That's the CPI year-on-year, if you just want the sort of vanilla one. Obviously, many other measures of core and super core inflation are available on the Bloomberg terminal. That is it for markets today. The Pulse is up next. European stocks moving higher, Guy.
They are. It's been a very strong week, and it looks like we're continuing that this Friday morning. Does it continue into the close? We'll find out a little bit later. This is Bloomberg.